All right, so here's day 22 of my journey to a $500,000 stock market portfolio. So let's look at the trades I placed September 11th. I'm recording this video September 12th, pre-market. And let's look first at the equity I've reached, or the balance. All right, so first in my margin account, my equity went up to 95.98. Now this is ridiculous. It was at 4,000 not long ago. So obviously you can tell that when the general market goes up, it has an exponential impact on the margin account. In my TFSA, 55,372, and in my RSP, 17,132. So breaking the 80s, finally, back to the 80s, 82,102, but can't be too happy or too excited because I know that at any time it could drop and erase all the gains. For example, if next week the Dow Jones drops 900 points, then my margin account goes back down to 3,000 or 4,000. So although I'm happy that the equity is going back up, but because most of my positions are going back up, but I've got losing positions, sadly. For example, United States Steel, Kraft Heinz, where if we look at Kraft Heinz, for example, my cost on Kraft Heinz is 36. And when stock was trading at 25, I sold a call option at a 27 strike. So now the consequence of that is come September 20th, if the stock is trading above 27, so if Kraft Heinz, which right now is trading at 29, if it's trading above 27, my shares will get called away at 27. But my cost is 36, so I'm going to lose the difference. So my only option to save that loss is to buy back the call option that I sold. But then if I buy it back, I have to pay $2.45 per contract. Well, I only collected 10 cents when I sold it. And as you can see, it's giving me a $470 loss right now. So if I want to save the loss or the difference between 36 and 27, I'm going to have to pay $2.45 just to save it. So I'm adding back to my cost of 36. So should I have sold a call option at 27 when the stock was trading at 25? So given that my strategy is covered calls, so I want to generate income from my capital every month. So if I just left Kraft Heinz at 25 when I bought it at 36 and just waited for the stock to come back up, I don't know when it's coming back up. It might continue to go down. It might stay at 25 for a while. So I'm not disappointed that I didn't wait because my strategy is to generate some income from any capital that's out there. Has to generate income, has to do something for me every month. When the stock was trading at 25, I went at a 27 strike, so I gave myself 2 points of room. But the stock still managed to go past that and even $2 more. But I mean, we are having a crazy rally that it's not a normal rally. The SPY went from 280s to almost 300 now in less than 2 weeks. So hopefully next week, I mean, things die down and maybe we go down a bit just so that my call options expire worthless. So I don't have to pay $470 just to buy back the call option to avoid losing my shares at 27 when I bought them at 36. So I've got this scenario here in a few of my positions. So on Kraft Heinz, Goodyear Tire as well. I've got a 12 strike. My cost is 14.8. Stock is trading at 14 now. So if I want to buy back, the call option is going to cost me $168. I'm going to lose $168. Halliburton, as you can see, it's pretty close. I've got a 20 strike. The stock is trading at 20.05. So this one could be safe. Teva, I've got a 9 strike. My cost is around 15 on Teva, and the stock is at 8.32. So I need one more week. I need Teva to stay below 9. I need Halliburton to stay below 20 come September 20th. I need NEO to stay below 4. I need CHK to stay below 2. But I think my biggest loser or my biggest concern is Kraft Heinz. I need it to stay below 27. All right, so if you remember, I made an earnings trade September 10th before market close on RH. Remember, it was an iron condor. Here, let me bring it up. All right, so September 10th at 3:59, so 1 minute before market closed, made this iron condor trade, collected $155 from this trade. As long as RH stays the next day, so earnings was coming out after 4. The next day when the market opens, as long as RH stays below 175 and above 140, then I'm safe because there's no more volatility in the stocks because the earnings is released. Then the premiums, the value of the premiums will go down. So the idea is to buy back the trade that you initially sold, to buy it back for a smaller value. Or I could let it expire till September 13, which is Friday. And as long as the actual stock stays between these values, then I keep the full 155 and my options expire worthless. But because I'm always afraid, don't want to be greedy, I decided to close the trade right away. And I was able to close it yesterday morning. I was able to close it at $30. So I sold it September 10th at 4 o'clock almost for $155. September 11th, I bought it back for $30. So I made a difference of, so the profit is about $125. So $155 minus $30, $125 profit, minus my commissions for an iron condor with Questrade, it's about $16 in and out. So I'm left with $109 net profit, but I was risking, in this trade, I was risking $345. So that's a 31% return on this earnings trade. So I'm pretty happy. I think it's my best earnings trade. I'll be placing 2 earnings trade today, one on Broadcom and maybe one on Oracle. And it'll be the same idea, an iron condor trade at expected move. Hopefully it becomes profitable like this one. But as soon as I placed this trade at 359 September 10th, I was very stressed because my risk is my max loss is $345. It's still a lot of money, $345. I mean, it would pay two police tickets, right? 2 traffic violations. But although the chance of that happening was small, because RH really needed to go out to move a lot for that to happen. I mean, it was trading at 158 and my ranges were 175 and 140. So for me to achieve max loss, I really needed RH to move a lot. So although the chance was small, but anything can happen. So I was still pretty stressed and nervous. Do not want to lose $345. But luckily it ended up staying, I think it opened at around $160. So it was still 15 points away from the upside and about 20 points away from the downside. So I could have kept it till Friday and just let it expire worthless and keep the full 155. But just to be safe, I closed the trade early and confirmed my profit. Actually, let's go see what it's trading at right now. 167. Wow. Yeah, definitely. I'm happy I closed it. That's why you don't be greedy and you take profits early. Wow. 167. All right, so yesterday sold a call credit spread on Micron. So Micron's trading at around 50, 51, but it has gone up considerably. If we look at the chart, I don't do much technical analysis, but if you just look at the past 1 month, I mean, look at Micron just shooting up. So I'm assuming that in the next month, it's not going to go above 55. It has to come back down to its average trading price, right? That's the assumption I'm making. So I sold a call option at a 55 strike, expiring October 18. So as long as Micron stays below 55 come October 18, I make a profit of the difference here, 116 minus 34. I think it was about 80 something dollars, $82, I believe. I got used to using a calculator. So yeah, no, it looks like it's $82. 116 minus 34. Yeah, $82. So, but I'm risking a lot though. I'm risking $418. So my return on capital is a potential 20%, as long as Micron stays below 55 come October 18. But I could potentially close the trade early. So let's say in 2 weeks, Micron is still trading at around 50, 51, even 52. Because time has passed by, the value in the options will go down, and I could probably close my trade early, let's say for $40. So I make a $40 profit minus commissions. I also placed an iron condor trade expiring October 18 on Shopify. It was trading at around 350. I went exactly 50 points higher and 50 points lower. So my ranges on Shopify is 300 to 400. So 300 on the low side and 500 on the high side. As long as Shopify stays within that range, come October 18, I make my max profit, which I believe was, I'm gonna have to calculate it, I don't remember, 533. I think it was around $200. 533 minus 458 plus 583 minus 502. Oh, it's actually $156. So $156 is my max profit on this Shopify Iron Condor. As long as it stays below 400 and above 300 come expiry date, I keep that $156 profit, credit, sorry, or I can close the trade early. Most likely I'm going to close the trade early, maybe for $75. So we'll see. Still have a lot of time. I have more than 30 days. I made an Apple Iron Condor trade. So on the upper side, 232.5, and on the lower side, 207.5. So these are my ranges. Collected $79, but the width of my strikes is only 2.5. So my risk is 250 minus 79. So my maximum loss on this trade is $171. So collected $79 with a risk of $171. So potentially return on capital, if I wait till expiration and I end up being right, is a 46% return. But most likely I'll try to close the trade early when as soon as it shows a decent profit. Because it's scary to wait till expiration, because at the last minute, at the last week, anything can happen and your profitable trade can become a big loser. So it's important to, in my opinion, from my experience, I've seen that it's important to close profitable trades early, but also close losing trades early as well. Don't let it go to max loss. Just close it early and then make another trade, adjusting for the market movement. But that's the hard part with credit spreads, is managing trades that go against you. It's something that I haven't fully mastered yet. But just like I mentioned in many videos, I'm continuing with this because I know it makes sense. I like the fact that you can trade wherever the stock is. You don't have to care if the stock is too expensive, if the stock is cheap. It doesn't matter. It doesn't matter where it is. You can trade wherever the market is, as long as you place a high probable trade and you give yourself a good range. If the stock stays within that range, you make money. Isn't that beautiful? So you don't have to worry if the market crashes, because if the market crashes, you don't lose all your positions. Your loss is defined. There's a max loss, but you could close your trade early. So let's say the stock is trading at 200 and you make, let's say you give yourself a range of, let's say 180 and 220, but then the market starts to crash. So then your initial trade you collected, let's say, I don't know, $100. So then when the market goes down, your trade is not going to be worth more. So let's say you close it out for $200. So you lose $100. But imagine if you owned the stock at 200 and then the stock crashes, you're just sitting with a losing position, not doing anything. Maybe it pays dividends, but you give yourself a range, the stock starts to go down, you close it early, but you immediately place a new range. So the stock was initially trading at 200, you placed a range at 220 and 180. Stock goes down to 180, let's say. So you close your trade early for a loss, but then you place a new trade between, let's say, 200 and 160. Because the stock is trading at 180, you place a new trade between 200 and 160. You collect a premium there. And usually when markets go down, volatility goes up, so the premiums go up. So you'll probably collect a nice premium from the new trade, hopefully to compensate for that other loss, and so on. So that's why I personally like credit spreads, is because of that, I guess, flexibility, the fact that you can trade in any market condition. I also placed a trade on AMD, but it didn't go through. I want to place a cover call trade on AMD. I mean, while everything is going up, AMD was going down. I might also sell a call credit spread on NVIDIA. So same idea as Micron, where I sold a call credit spread at 55. I'm thinking of selling one on NVIDIA at around 200, 205, because it shot up like crazy in the past month and went from 148 to 184 Will it continue to go higher? I don't think so. I think it's just gonna slow down, come back to average, maybe drop down a little bit. So I don't think it's gonna go above 200 or 205 in the next month. So I could sell a call credit spread at around 200 or 205, collect the premium. As long as Nvidia stays below that number, then I keep the premium. But I'll see if the premium is worth it or not when the market opens. And also I'll be placing earnings trades on Broadcom. I think Broadcom for sure I'll be placing one. Oracle, I'm not sure yet. It'll depend if the premium is worth it. I do have some buying power in my TFSA though, about 10,000 US. So I'm looking for covered call trades in my TFSA because I can only do that. I can't do credit spreads in a registered account. But I feel like I've lost some confidence with covered calls. So I'm trying to be a bit more selective in the stocks. AMD, I'm comfortable buying AMD, and I'll be looking for other things to buy as well. All right, so this is it for day 22. I think we're at day 22. So if you have any questions, leave them in the comment section below. And like always, if you're going to open an account with Questrade, use my referral code, which you can find in the description below my video, so you can get up to $250 back. Simply use it before opening the account, which you can see here. Thanks for watching.